Hey there, savvy investors of Singapore. It's your financial guide, Iggy from Investing Iguana. Today, we're diving into an intriguing analysis titled Analyzing Sheng Siong, a 2024 turnaround story. We're going to peel back the layers of Sheng Siong's recent financial performance and explore the key factors that could signal a potential turnaround in 2024. From their recent share price dip to their aggressive expansion strategy, we'll dissect what these developments could mean for investors like you. Are we looking at a temporary setback or the cusp of a major comeback? Buckle up as we delve into the insights that could shape your investment decisions in one of Singapore's leading supermarket chains. 1. Navigating a downbeat year. The past year has been a challenging one, particularly for investors. One of the major hurdles they faced was inflation, which has been a constant source of concern. Amid these testing times, the journey of Sheng Siong's share price has been noteworthy. It reached an all-time high of $1.83, but since then, it has experienced a decline of 14.2%. However, this decline is not indicative of failure, but rather, it paints a picture of resilience in a difficult market environment. As we transition into the year 2024, Sheng Siong is not standing still. The company is planning to make strategic moves to strengthen its position in the market. One of these strategies involves bidding for more HDB shop spaces. HDB, or the Housing Development Board, is Singapore's public housing authority, and securing more shop spaces in these areas could significantly increase Sheng Siong's presence and reach. Moreover, Sheng Siong has set an ambitious goal for itself to open at least 3 new stores each year. This is a clear indication of the company's growth mindset and its commitment to expanding its operations. These strategic moves by Sheng Siong could very well be the catalyst that its share price needs to soar again. While the past year may have been downbeat, the company's proactive strategies and resilient spirit suggest a promising future. As always, only time will tell how these plans will unfold and what impact they will have on Sheng Siong's share price. But for now, it's safe to say that Sheng Siong is on a path of strategic growth and expansion. First, let's address the elephant in the room, Sheng Siong's share price. There's been a 6% dip over the past year, and the stock is currently hovering below its all-time high of $1.83. This drop reflects investor concerns over inflation impacts on consumer spending. However, it's essential to remember that the stock market is often a forward-looking entity, and what we're seeing might be more of a reaction to immediate market conditions rather than a long-term trend. 2. A closer look at the numbers. When we delve into the financial performance of Sheng Siong in the first 9 months of 2023, we find a combination of resilience and challenges. The company's revenue saw an increase of 2.6%, reaching 1.04 billion Singapore dollars. This growth, albeit modest, is a positive sign, indicating that the company has been able to generate more sales. In addition to the revenue growth, Sheng Siong's gross profit also rose by 4.3%. Gross profit is an important indicator as it reflects the core profitability of a company before operational costs and other expenses are deducted. The rise in gross profit suggests that Sheng Siong has been successful in increasing its profit margins or reducing its cost of goods sold, or both. However, it wasn't all smooth sailing for Sheng Siong. The company's net profit, which is the actual profit after all expenses have been deducted from the revenue, took a slight hit. This was primarily due to increased staff costs and utility expenses. These are operational costs that a company cannot avoid, and they have a direct impact on the net profit. Despite the dip in net profit, one aspect of Sheng Siong's financial performance that stands out is the 125.1 million Singapore dollars in free cash flow. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's a key indicator of a company's financial strength, as it shows the company's ability to generate enough cash to pay its debts and fund its operating expenses. The fact that Sheng Siong was able to generate such a significant amount of free cash flow, despite the challenges it faced, highlights the supermarket operator's financial muscle. It suggests that the company has strong cash management strategies in place and is capable of maintaining a healthy cash flow even in tough market conditions. This could be a positive sign for investors, as companies with strong free cash flow are often better positioned to invest in growth, pay dividends, and weather economic downturns. In conclusion, while Sheng Siong faced some challenges in the first 9 months of 2023, its financial performance demonstrates resilience and strategic financial management. Heading into 2024, Sheng Siong's strategy to bid for more HDB shop spaces is particularly noteworthy. They aim to open at least 3 new stores each year, which could be a significant growth driver. Historically, new stores have been a key contributor to sales increases, and if this trend continues, we could see a positive impact on Sheng Siong's top line. 3. Expanding its footprint. Sheng Siong's dedication to expanding its business is clearly demonstrated through its consistent growth in the number of stores and the retail area it covers. The company had 67 stores at the end of 2022, and by September 2023, this number had increased to 69 outlets. This growth is not just about increasing the number of stores, but also about expanding the company's physical presence in the market. In addition to increasing its physical footprint, Sheng Siong has also expanded its range of products. This means that the company is not only reaching more customers through its additional stores, but it's also offering a wider variety of products to meet the diverse needs of its customer base. This strategic expansion of product range is a key part of Sheng Siong's growth strategy, as it allows the company to cater to a broader market and attract a wider customer base. Moreover, the new stores that Sheng Siong has added are contributing significantly to the company's sales. This shows that the company's expansion strategy is not just about growing in size, but also about increasing its revenue and profitability. The new stores are not just additional outlets, they are strategic investments that are driving the company's sales growth. From my viewpoint, Sheng Siong's growth strategy is aggressive and action-oriented. The company is not just planning for growth, but it's actively pursuing it by increasing its store count, expanding its retail area, broadening its product range, and strategically adding new stores that contribute to its sales. This proactive approach to growth is a clear demonstration of Sheng Siong's commitment to expanding its footprint and strengthening its position in the market. It's a strategy that's not just about surviving in a competitive market, but about thriving and growing in it. As of September 2023, Sheng Siong operated 69 outlets, a slight increase from the previous year. This expansion is crucial as it directly impacts sales. New stores contributed a 3 percentage point year-on-year increase in sales for 9M 2023. With plans to open more stores in 2024, we're likely to see continued top-line growth. 4. Margins on the rise. Investors, take note. Sheng Siong's gross profit margin is on an upward trajectory, having surpassed the 30% mark in Q3 of 2023. This consistent increase, largely thanks to a favorable sales mix and higher sales of house brand products, is a crucial factor that could mitigate cost pressures and boost the business in the long run. This steady growth in gross profit margin is primarily due to 2 factors. First, a favorable sales mix, which means the company has been successful in selling more of its high-margin products. Second, there has been an increase in the sales of Sheng Siong's house brand products. These are items that are produced by the company itself, which typically have higher profit margins compared to products sourced from other suppliers. The consistent increase in the gross profit margin is a crucial aspect that could help the company in mitigating cost pressures. Cost pressures refer to factors that could potentially increase the cost of running the business, such as rising raw material prices or higher wages. A higher gross profit margin provides a buffer against these pressures, ensuring the company can maintain its profitability even in challenging circumstances. Moreover, this upward trend in gross profit margin could also boost the business in the long run. A higher gross profit margin means the company is making more profit for each dollar of sales. This additional profit can be reinvested back into the business, for example, to expand operations, improve product offerings, or increase marketing efforts. This reinvestment can lead to further growth in sales and profits, creating a positive cycle of growth. From my perspective, the rising gross profit margin of Sheng Siong is a positive sign for potential investors. It indicates the company's strong financial performance and promising future growth potential. Therefore, it's definitely something that investors should take note of when considering their investment decisions. 5. Capitalizing on new HDB flats. With an aggressive strategy in bidding for more HDB shop spaces, Sheng Siong is poised to capitalize on the growing network of stores around Singapore. The company has adopted an aggressive approach in bidding for more HDB shop spaces, which are commercial units located within public housing estates. This strategy is aimed at expanding Sheng Siong's network of stores across Singapore. The recent surge in the construction of new build-to-order (BTO) flats, which are public housing units built by the HDB, presents a significant opportunity for Sheng Siong. These new residential developments often come with retail spaces that can be used for supermarkets, providing Sheng Siong with potential locations for new stores. Furthermore, the Singapore government's commitment to increasing retail catchment areas is another factor that could benefit Sheng Siong. A retail catchment area is the geographic area from which a store or a shopping center draws its customers. By increasing these areas, the government is essentially creating more potential customers for retail businesses like Sheng Siong. This combination of new HDB flats and expanded retail catchment areas provides a fertile ground for Sheng Siong to increase its store count. The company is particularly interested in new HDB areas, as these locations often lack established supermarkets. By opening stores in these areas, Sheng Siong can effectively establish a strong presence and capture a significant share of the local market. Sheng Siong's strategy of capitalizing on new HDB flats demonstrates the company's proactive approach to business growth. By seizing the opportunities presented by the increasing number of HDB flats and the government's efforts to expand retail catchment areas, Sheng Siong is well positioned to strengthen its network of stores around Singapore and enhance its market position. Heading into 2024, Sheng Siong's strategy to bid for more HDB shop spaces is particularly noteworthy. They aim to open at least 3 new stores each year, which could be a significant growth driver. Historically, new stores have been a key contributor to sales increases, and if this trend continues, we could see a positive impact on Sheng Siong's top line. 6. The road ahead, bids and prospects. Looking ahead to 2024, the success of Sheng Siong's business strategy is largely dependent on the results of its bids for new stores. The company has been actively participating in auctions for retail spaces, particularly in areas with new HDB flats. Winning these bids would allow Sheng Siong to open new stores, expand its network, and potentially increase its market share. In addition to its operations in Singapore, Sheng Siong also has a subsidiary in China. This overseas venture has been showing signs of profitability, which is a positive indicator of the company's international growth potential. Plans are already underway for the opening of a 6th store in China. This expansion not only diversifies Sheng Siong's revenue streams, but also provides opportunities for the company to tap into the vast Chinese market. These strategic moves have created a sense of anticipation among investors. They are eagerly waiting to see how these initiatives will impact Sheng Siong's performance. At the same time, there is also a sense of patience. Building a successful retail business takes time, and the outcomes of these strategies may not be immediately apparent. One of the key questions on investors' minds is whether these strategic moves will enable Sheng Siong to revisit its former share price glory. Share price is often seen as a reflection of a company's value and performance. A return to its previous high share price would signal to investors that Sheng Siong's strategies are paying off and that the company is on a strong growth trajectory. In conclusion, the road ahead for Sheng Siong in 2024 is filled with both opportunities and challenges. The company's strategic moves, including its aggressive bidding for new stores and expansion in China, could potentially drive its growth and enhance its market position. However, the success of these strategies hinges on various factors, including the outcomes of its bids and the performance of its China subsidiary. As such, investors are watching these developments closely, with a mix of anticipation and patience. And that wraps up our deep dive into Sheng Siong's financial journey and what the future might hold for this retail giant. We've navigated through the highs and lows, from share price trends to their ambitious expansion plans, giving you a comprehensive view of Sheng Siong, a 2024 turnaround story. If this analysis has given you food for thought, why not share it with your fellow investors? Your support helps us keep bringing these valuable insights directly to you. Don't forget to hit that like button, share this video, and subscribe to Investing Iguana for more in-depth analyses on Singapore's bustling market. Drop a comment below with your thoughts or questions about Sheng Siong's future. Until next time, keep those investments smart and your financial knowledge sharper. This is Iggy, signing off. Happy investing, and see you in the next one.